Welcome to the Tower Wealth Advisory podcast series. I'm Tyler.
I'm Dave.
And today we're talking about turning your business into retirement income using insurance planning to enhance your wealth. So we might as well just jump into our slides, Dave.
Sounds good.
So how can insurance products help me increase the value in the sale of my business? That's really what we want to dive into today. A lot of people think of when they sell their business simply taking that lump sum of money that they've gotten from the sale of their business, investing it in a portfolio of investments, whether it's GICs or a savings account or a portfolio, and then living off of that return. But there's some cool strategies that we can use on the insurance side of things that we're going to get into today.
Yeah. I mean, ultimately, using insurance inside of a corporation enhances your value. I'm not sure it would boost, say, the sale value of your business, right. But once you separate out your portion to what you sell, you still maximize your value.
Yeah, that's what we're talking about today.
Yeah.
So as you guys know, if you've been following us, Dave and I are duly licensed as portfolio managers. So we do investment planning, but we also do insurance planning. So both of these fields offer unique planning opportunities, often only afforded to those who are business owners. So our goal is to provide advice that centers on tax minimization and the take-home money in your jeans maximization. And that's what Dave's talking about. It doesn't really enhance the value of your business. What it enhances is the value that you receive out of your business. Right? So that's what we're getting
to.
I
think a big thing on this is, there's two sides to this. When most people, well, I guess you could say there's three sides. I mean, there are tax lawyers who do lots of structure and strategy for people's corporations to enhance their wealth. But in our business, there are insurance advisors sometimes, there's portfolio managers, and there's not a lot that do both disciplines and then work those disciplines together to maximize shareholder value. And I think that's what we essentially do. We're not lawyers, obviously, so we don't do the advanced tax planning that you would get from a tax lawyer. But, if you ever have had an insurance product presented to you, it usually is describing how that insurance performs compared to an investment. And a lot of times that's coming from someone who only sells insurance. They don't sell investments. So naturally, they're going to show that insurance product is a better return overall than you're going to get from your investment product. And generally when they show that too, the return on the investment product is always like interest or dividends. It doesn't factor in capital gains. So it doesn't factor the lower tax rates that truly happen on a properly structured investment portfolio. So I think what we're saying here is you have to look at both, and there's a great integration between these two, maximizing your value from both investments and the use of insurance and using tax strategy for both of those.
For sure. So insurance planning, a successful succession plan benefits from an advanced insurance plan. That's a mouthful. So insurance planning, it holds a unique position in the Income Tax Act. It allows a corporation to transition assets out of the company to shareholders in a tax-efficient means. So sometimes no traditional investment portfolios can do that. It can only be done through the insurance avenues in the Tax Act. So there are many strategies that can be used. All are extremely unique to the individuals they're designed for. And ultimately, we're going to suggest here a review will reveal what strategies will work best, with the target being to produce an internal rate of return that matches or exceeds an investment portfolio while providing insurance coverage, often essential to protecting one's assets. So usually the best way to look at these concepts is to explore a couple of them. We're not suggesting that they fit everybody that would be watching this, but it gives you an idea of what can be done. So number one, the first example would be using life insurance as an investment vehicle. So in this example, the business has been sold, a portfolio of investments has been created, and now we're looking for other ways to extract retirement income from your holding company and diversify your investment picture. So what happens in this situation is we have a whole life policy that will be purchased inside of the company. And in this example, we've got a male who's 50 years old, and he's going to be depositing $100,000 a year for 10 years into this participating whole life policy. Right out of the gate, there's a death benefit of $1,275,000 in the first year. So that's the amount of life insurance that this guy's technically purchased.
Yep.
So if he dies that day, that's what pays out to his estate.
The rate of return is astounding.
The rate of return if he dies day one is unbelievable. It's in the thousands of percent.
And all for someone else.
Yeah.
Not him.
That's right. So we go to our next slide and we break this out a little bit. So the first point here is that there's cash values that become or that are created with this $100,000 deposit that happens each year. So at year 15, if we fast forward into the future and we use the current dividend scale that's available by that insurance company that you've purchased your policy from, the value would be $1.2 million. That's what's sitting as cash value inside of the policy. So this cash value is held in the company's life insurance policy, and it can be used for the purpose of leverage. So some people may use this as a source of income in retirement. You might take your policy to a lender and say, hey, I've got $1.2 million saved up as cash surrender value in my policy. Can I borrow against that? The lenders will typically agree to that fairly readily.
They like insurance policies more than they like real estate.
That's what we've been told, yeah. And it's mostly because the insurance companies have been around for, many of them, 150 years.
150 plus, yeah.
And they've got such a long dividend stream of history that performance is very easy for the bank to see, and they can then lend very comfortably against that asset. So a business owner then takes this policy, which is corporately owned to the bank, and may borrow against it for income in retirement. Now, the other thing that he's sidestepping here is any personal income taxes. So he's borrowing and he's living off of a loan versus living off of income that is taxable.
From the corporation.
Right.
Yeah. Yeah. And so right away, though, just at least one comment is this is quite the structure.
Yeah.
It involves getting all the pieces right, and would involve your other professionals. You would definitely need some legal counsel and your accountant to make this work. Because if you do it wrong, then what you just have is a whole bunch of taxable income and a CRA problem.
Yeah. There's a bit of certainly some accounting features that need to be added in here if you're using this strategy, but it does give people a way to create a unique source of income in retirement. We would call it a secondary source. We typically wouldn't recommend it. This is your primary source of income in retirement. But if you need extra income in retirement and don't want to be more higher taxed, then here's a way to use a policy like this.
I think that caution is fair. And for everybody who looks at any insurance type scenario inside of their corporation or personally, there is no one solution that's going to be the greatest solution. If you take all your assets and put it into one vehicle, whether it's investment insurance or anything, you are taking great risk. And that's why we always say, you have to diversify, and by diversification, we still mean some insurance, some investments, some real estate, your business, all sorts of things. So if someone's got the greatest thing since sliced bread with all your money in your corporation, it's quite the risk. Yeah,
absolutely. So that's part of this strategy. At death, when a business owns an insurance policy, at death, what happens to that policy? So let's say that the insured person dies now.
So basically, there's two components to your policy. In this kind of policy we're describing, there's a death benefit and there's a cash surrender value. And in many cases, that death benefit has been increasing over the years because the dividend that's being paying out is buying more insurance. So that increases dramatically. You have a cash surrender value, which is something that you might have borrowed against. And when you pass away, the greater of the two pays out. So the death benefit or the cash surrender value. Usually the death benefit's greater, especially if you've been paid up insurance. So it pays out. So depending if you had a loan, I think we'll just look at this that you don't have a loan against your policy, but the death benefit pays to as a tax-free benefit to your beneficiary. And in a corporation situation, it is your corporation who's your beneficiary. And then that money goes immediately to your CDA or your capital dividend account, and it can be paid out to any shareholder of that corporation as a tax-free benefit. Now, there could be a little bit of an ACB issue, and that just purely revolves around your premiums and how long you've been paying for it, and that's calculated inside the policy. And if it's been around a long time, your ACB generally gets down to zero. If this is a short, you've owned the policy for 5 years, you pass away, the ACB could be up there a bit, but at the same time, you've only put very small amount of money and you're getting a very big benefit out of it. So yes, there'll be a little bit of taxation.
Gotcha. So this strategy is often used by business owners who recognize they will not be spending all of their assets and are looking for ways to transfer tax efficiently out of their corporation. So you just kind of touched on that. At death, all of the assets in this policy pay out through the capital dividend account tax-free to the heirs of the company.
Or not necessarily to the heirs of the company, but to the remaining shareholders.
Right, to the shareholders.
Right, which, could be your beneficiaries on your will, could be existing shareholders, could be your kids or your spouse who's already a shareholder of this corporation. So therefore it pays to them, and that doesn't, it won't impact what your will says. So if it's already stipulated inside of your corporation, then that, it still requires that you would have a lawyer make sure that what's written for your corporation and what's written for your personal will work well together, or else you could have problems there.
Right. Great. So we'll go to our next slide. So this might be a little bit difficult to see, but it gives you some numbers, I guess put some meat on the bone in terms of what we're talking about here and how we can compare it to an alternate investment. Dave said at the start, if you're an insurance person, you always want to compare to an alternate investment and make the insurance look better. But in this case, it actually is. The alternate investment is showing
it's a GIC at 4%.
At 4%.
I love that. Can't even get a GIC at 4% right now, but it's 100% taxed. Yeah.
It's 100% taxable, and the life insurance would be taxable if you were to pull the cash out.
Right.
But so they're compared equally in that manner. The insurance is illustrated there on the right-hand side. It's called an estate bond, and the alternate investment is on the left-hand side. That's your GIC investment. Right. So you can see there's a couple of different columns there: an investment fund underneath the alternate investment, and accumulation fund underneath the estate bond. So in the life insurance, we call it an accumulation fund. If you look at those two numbers, even 11 years out, they're really quite equal. There's about 1,150,000 in the investment fund, and just about 1.1 million in the accumulation fund. So not a heck of a lot of difference, I guess, in terms of the cash values. They are slightly different because a portion of the 100,000 that's going in is actually paying premiums
for risk
on the insurance side. So it doesn't not 100% of it is going into investment and savings. But that $1 million that's sitting there as it grows by the dividend stream of the insurance, that's a non-taxable dividend. It's happening inside of the policy. It's not streaming out a T-slip to the owners.
That's right.
So that's kind of nice.
And even in a scenario that you have an investment that's not a GIC making 4%, I mean, what says it right here, you need a 7.28% pre-return in an investment to break even with this insurance example. Well, you and I know to get a 7.28% average rate of return, you have to have a pretty aggressive portfolio, not aggressive, but very growth-oriented investment to achieve that. And that's just to come out at the end 36 years later to break even with an insurance policy. So you need a long-term return to get that same benefit as an insurance policy. Well, that's saying you don't die in those 36 years. You die anywhere in those 36 years, your return is way higher.
Yeah.
So, I mean, right off the hop, you are protecting your family, you're protecting your business with something that's going to provide a much higher rate of return, regardless of the investment return outside of a policy.
Yeah. And that's what we wanted to compare there. That's perfect. Yep. So our next slide here is another strategy that can be used inside of a corporation. A way to access funds, get funds out of the company in a very tax-efficient manner is using critical illness insurance. So using critical illness insurance to protect you and your business while you're working and to give you a pipeline for money to be removed from your company tax-free in the future. So how does this work? This is our second example here. Oftentimes, this is referred to as a CI split dollar or a critical illness split dollar. And what we're talking about here is split ownership. So in the first step, the company, your company or the business owner's company, purchases a critical illness policy on its key employee, which is often the owner, and the premium for that critical illness insurance policy is paid for by the company. And then the second point there is that the key person pays for a rider on the policy personally. It's called a return of premium rider. And so this allows 100% of all premiums to be returned to the key person. Typically, this is happening in the 15th year of the policy. And then final point here is that this return of premium follows the rider and the one who has paid for it. So the company paid insurance premiums are now paid out to the key person as an insurance benefit and therefore are tax-free. So that's a brief breakdown of how the strategy works. So if we go to our next slide, again, we're going to talk about this fictional guy who's 50 years old. He's a non-smoker, and he's looking to contribute $75,000 a year for 15 years to enhance his retirement. He's also concerned about a serious illness affecting his ability to operate his business in the next 15 years. So what he does is he goes out and buys a $2 million critical illness insurance policy. That's going to cost him the $75,000 a year. And at age 65, he's able to cancel that policy and receive $1,124,000 back through the company to their personal hands. And if they die prior to the 15th year, 100% of all the premiums will be returned to the estate. So what ends up being created is what we call a never lose policy, which is sometimes rare in the insurance world.
Yeah. I mean, ultimately what you're doing here is you're giving up $75,000 a year to cover some risk. And ultimately you're giving up the ability to grow some money from that $75,000. And, if you invested that, you're going to owe some tax on the growth and so on and so on. But if you suffer critical illness in those 15 years, you probably have not accumulated enough money to offset this $2 million.
Right.
And when you talk about a critical illness, you got 24 serious illnesses and injuries. What's a critical illness ultimately for somebody who doesn't know?
Well, critical illness is going to be taking you out of your business. But if you have to define what it is, there's, illness was like cancer, heart attack, stroke, multiple sclerosis. There's some on there that
loss of
limbs, loss of independent existence is a big one. So if you aren't able to care for yourself and you need care in the home, that's going to cover it as well. And that is a tax-free amount that comes out, the $2 million. So like you mentioned, to try and save up $2 million inside of your business so you can either get the care that you need, meaning skip lineups in Canada and go to the States to get immediate health care. Or if you need an injection of cash in your company to keep it running, maybe you've got to attract a key person that'll help step into your shoes because you've got to take time away. That money, where is that going to come from to do those sorts of things? And that's where critical illness comes in.
Right. And generally with the critical illness, in order for it to pay out the benefit, you have to survive that critical illness for 30 days.
Yeah.
Okay. Just covering off the little pieces.
Covering off all the little pieces. So let's go to our next slide. So there can be 3 end results in this, and this is just in visual form. I already noted it on the previous slide, but 3 results could be: number 1, as Dave mentioned, you get sick. Hopefully not, but if you get a critical illness, you survive 30 days, you're going to get a $2 million check that pays into your company. Once it's in the company, how can we deal with it from there? Once that $2 million is in there.
Well, once it's in the company, you have to flow it out to yourself personally if you're going to use it personally, and it'll be taxed. Or if it's money that you're going to keep in the company, you can invest it. You can do all sorts of things and just draw out a dividend when you need the money. I mean, as we always say, don't pay tax on money that you're not using. So the day you're converting that dollar to something that goes out of your pocket is the day you want to realize tax.
Those are good points. And I guess the other one to be made here is the $2 million benefit that pays in isn't a receipt-based thing. It's not based on the health care that you're trying to receive. Some people are, think that in order to get their critical illness benefit, they have to produce receipts and prove and submit expenses as to what they've.
No, it can be used for virtually anything. I mean, we've had clients that have claimed on these before, and I recall one of my clients, stopped driving because of her situation. So she was constantly using a driver or Uber or a taxi. Her health became very sensitive to any type of environmental or pollution type situation. So extensive. She hired cleaners that did, micro cleaning and came in 3 times a week. Those are all very expensive things. But because she had this money now, it allowed her to go down that road. At the same time, too, that burns up the money quite quickly. And all of a sudden, if you don't have something like this, you're now burning up your retirement money. So if you survive your critical illness, you've used up your retirement money. Now you got to go back to work. Yeah. Or if you don't survive it, you've basically burned up what assets you had. And if you had any aspirations to leave something for your beneficiaries, it's gone.
Yeah.
Trying to save yourself, which everybody really should do or would want to do, is to take whatever measures they could to try and prolong their lives.
That's right. So that's our first example of what can happen in these policies. The second example in the shared ownership strategy here is that death benefit could pay out. I mean, hopefully not for this person, but in the next 15 years, what if they die? And in this example, this shows them dying in the 10th year. And so that amount that's paying out, the $749,545, that's a death benefit, and that equates to 10 years of premiums at $75,000 a year.
And that pays to the executive, not to the corporation, so it's a tax-free benefit to the individual.
Yeah. So it pays out, and the heirs of that executive get that dollar amount.
Yep.
And the final example or final option or final thing that can happen in these policies is the health benefit pays out, and that's the return of premium. So in this case, that's 15 years of premium. That's how we get to that $1,124,000. And that's at this guy's age 65. So all of that comes out of the company and is paid directly to the executive.
Yeah. And I mean, some of these terms are deceptive in a way. Health benefit, you kind of feel like, oh, so I got a CI. Yeah, I know. They say exactly this is the healthy benefit. So I think this is great. You gave up some time value of money is what you gave up. You got 1.124, which is what you put into it. You got no return other than you got your money back, but you covered off a $2 million risk potential for 15 years. That's not a bad trade-off for that.
That's true. So my next slide here is succession planning in general. The old adage, people don't plan to fail, they fail to plan, is certainly relevant when it comes to succession planning in one's business. So from our perspective, or from a wealth management perspective, it is essential to start sooner rather than later. Planning the succession of your business will result in more net proceeds on the sale of that business. So be sure to engage with experienced, qualified professionals. No two businesses are alike, and no two business transitions are the same. Having a plan tailor-made to your needs is essential, and insurance, as we've seen, can enhance the value in the sale of your business. Any other comments, Dave?
No, I think, I guess so. I mean, really, they're great tools. As we've always said, insurance in your business sometimes comes at a stage as well where there's excess money, and some of that money is not needed for retirement income. So that's what makes it even better, a better environment to look at the use of insurance. And kind of maybe up at the top too, we try and get people to look at this earlier than maybe when looking at for retirement or for the sale of the business, because part of it is this is all underwritten based on your age and your health. So we all know as you age, well, the premiums get more expensive and the ability to be insured gets more difficult. So it's important when you have a corporation to look well in advance to your succession planning or your sale of business or your transition to retirement.
And it can be hard. I mean, when you're first developing your business, just growing your business, to have that foresight and look down the path and try and see these things is sometimes really difficult. And I think that speaks to why you should be engaging with advisors like ourselves, because we are looking that far down the road. We're not just focused solely on our business and what's in front of us. We're looking at what's going to happen to that business in the future and trying to create these pipelines and ways to extract money from that business, because we know it's going to be there if that business becomes successful.
Right.
So,
well, our biggest battle with our business owners who are younger and successful and growing is they don't want to give up any of their assets for traditional investments in insurance for the most part, because their growth trajectory is quite good. And they're looking at, I'm growing 20, 25% per year. None of what you're showing me can do the same. So a lot of what we're doing is for preventative and very future results. And they're looking at their business in 2, 3, 4, 5-year increments. This stuff all becomes very important, and by the time they decide that they're willing to do it, it's very expensive compared to what it would have been.
It's harder the later you go. Yeah, absolutely. Well, thanks very much for watching this episode of the Tower Wealth Advisory podcast series. If you want to learn more about us, follow us on social media or go to towerwealth.com.